It's Africa Business Weekly, your weekly source for business news and insights from across the continent. Hello and welcome. I'm Akin Obakeye. We're halfway through the year and it's time to take stocks of the trends shaping Africa's business landscape. On this episode, we'll explore the key developments driving growth, innovation, and entrepreneurship in Africa. From the impact of the Iran-Israel conflict on markets to Tech Startup Act in East Africa. All these and more will be on the show today. Karabo is on standby to give developments from Southern Africa.
Good evening, Akin. Well, fluid tariff developments and U.S. fiscal worries dominated global financial markets last month. On the local front, the eventual passing of the local budget after the third time of trying, together with a more risk-on global sentiment and more favorable local rate expectations, supported a solid performance from South African equities, with the industrial sector the star performer. The question is, can it continue? For more, CNBC Africa's Nastasia Arendse spoke to Mamukete Lejane, market strategist at Standard Bank CIB, and Isaac Odendal, who is an investment strategist at Old Mutual.
There's an old saying that the stock market is not the economy, and I think that's very much true in South Africa's case. The JSE simply does not reflect entirely the South African economy, and I think some of the big drivers have been especially the gold and platinum price that really supported those shares. And for instance, ironically, if you look at the GDP numbers, the poor performance of mining production actually detracted from GDP in the first quarter. So you've got this sort of things moving opposite direction. The price supports the profitability of the mines, but the GDP or the economic growth impact has been pulled down by the fact that production has been under pressure in the first quarter. So that's kind of the one thing. The other thing is just simply, I think markets are forward-looking. So even though the historic economic numbers or the trailing economic numbers have been pretty pedestrian, I think there's still a general expectation that growth over the medium term in South Africa will improve. I mean, you mentioned things like lower interest rates and more political stability and so on. So I think there's also a sense that things can look better in South Africa over the medium term. And then I think finally there's this element of a global shift away from the dominance of US equities. And so in that sense, South Africa is not particularly special. We just form part of a basket of non-US equities that have been unloved and unfavored for, about 15 years now. And suddenly it seems like global investors are thinking differently about the world outside the US.
Building on that, Mamukete, let me come to you, because for quite some time now we've been talking about this fade of US exceptionalism, American exceptionalism, however you want to define it. Where are we with that, given everything we've been through, and especially at a time when you looked at markets and you'd swear nothing happened during that period of April?
Been really, really interesting. I think the one way in which we can look at this actually is when we look at stock markets on a currency adjusted basis. So if you look at the S&P in dollars, it looks okay if you look at what has happened. But if you look at what the dollar has done, and you think of it, for example, if you're a South African investor and you've lived through a period over which the rand has actually strengthened a little bit, but your US investments have basically stagnated, and the local market is up 18% or whatever the case may be. I think it's about 11 this year. Then you're actually losing. So if you look at it if you don't adjust for currency, it looks like the US stock market is okay, like nothing has changed. But if you start to adjust for currency and you think about it from the perspective of an investor who's investing, who's saved in another currency and is invested in dollars, then you start to see that actually investors are quite behind in US equities this year.
Let me stay with you, Mamukete, because while we're still talking about the idea of the fade in US exceptionalism, we're still having these developments that we're seeing around the dollar, which has brought in this conversation around some of the market participants that perhaps this will be good for growth in emerging markets. We should start sniffing around there. What's the conversation as you interact with other investors about where the opportunities could be if it's not the US?
There's two things happening here. One is around American exceptionalism in the sense of the flight to quality, safety, and is there shift in understanding about what safety looks like. Maybe safety no longer looks like the dollar. Maybe it now looks like the euro. And that money then flows out of the US, maybe into euro or JPY or other developed economies.
South Africa's headline inflation held steady at 2.8% in May, remaining well within the SARB's target range. But what's driving the numbers under the surface, and what is the impact on households and the economic outlook? For more, CNBC Africa's Namonde Xulu spoke to Zandile Makhoba, economist and lead specialist for research and insights at Liberty.
We're 2 months into the second quarter here, and staying well below that 3% mark. So our target range still sits between 6 and 3%. So 2.8% for 2 months now. We'll see how June fares off. But what we're also seeing is that the average inflation for quarter two so far is below the inflation rate we saw in quarter one. So we're trending downwards, which is positive news just in terms of consumer spend, and should at least be positively influential in terms of the monetary policy committee's discussions.
What factors contributed mostly to the May CPI figure? Food prices rose, but fuel costs declined sharply. What were the drivers here?
Yeah, we're seeing a downward trend just in terms of the transport prices, and it's double-digit declines from last year. So we're seeing about 12%, 15% in terms of diesel and petrol, which is good in terms of other elements as well. So we know that fuel prices do have an influential factor in terms of like food and other essential prices within the South African context. So we are seeing that a lot of the decline is coming from there. Beyond just the fuel or transport component, we did see declines across most categories in terms of spend. It's only the food component that really had notches that were going up here and there. So it is an encouraging element. It is a function of some of the external factors that have been driving inflation starting to ease in terms of the internal market. It also does expose that what we're seeing domestically is very low consumption habits. So that internal heat in terms of the economy is not something we're seeing. And that is further outlined in terms of our GDP numbers, where we see that, we're still well below 1% in terms of GDP growth.
Talking about that consumer pressure and looking at households, are households seeing any kind of meaningful relief yet, or is cost pressure simply shifting across the various categories?
I would say that there are households that would experience a lot less pressure. So just if you look at the differentials between the first and last income deciles in the CPI basket, our lowest income earners are still experiencing an inflation rate of about 4.5%. 4.6%, whereas right at the top end, inflation is averaging around 2.5%. So there's definitely households that are worse affected. It is driven by this element of food inflation. For example, maize prices year on year, 14% up, SAMP 21%. So you are still seeing that very essential goods for certain households are still significantly up in terms of prices from last year. And that is going to impact different households differently.
And those were some of the major stories driving the southern tip of the continent for this week. You can, of course, catch these and more on our website, cnbcafrica.com. But for now, it's back to you, Akin.
Many thanks there, Karabo. Let's join Tabitha now for some stories from East Africa.
Hello Akin. This week, Tanzania and Ethiopia stood out. We kick off with the Dar es Salaam Stock Exchange, which saw mixed activity. While equity turnover fell 1.53 billion Tanzanian shillings and market cap dropped over 400 billion Tanzanian shillings since May, bond trading jumped to a robust 23.39 billion Tanzanian shillings, a clear signal of investor appetite for government debt. I was joined by Imani Mohingo, Senior Manager at CRDB Bank, for more insights.
The turnover is just normal market volatility. We have seen a number of block transactions in a few weeks ago, and comparing them to this week where there were fewer block transactions. That's why we see a bit of a dip in the equities turnover, specifically equities turnover. But the dip in market capitalization, that is mostly due to the implementation of the new trading rules. We had a discussion here last time I was here about the new trading rules that the DSE had enacted. And the implementation of the new trading rules began on 2nd June, so the beginning of June, since the beginning of May. And the primary objective of these trading rules were to improve price discovery, especially on the counters that were locked for about 5-7 years, other counters. We saw specifically 3 counters, TBL, TCC, and Vodacom, have been stagnant for more than 7 years. So the main challenge was the trading rules, and they were amended to accommodate more transactions, to accommodate improved price discovery and liquidity on these counters. And since the beginning of June, we have seen some movement in these counters, particularly Vodacom and TCC. Vodacom has gone down by 38% since the beginning of June, since the implementation of these new trading rules. All TCC has dropped by about 2%. So mostly the dip of 400 billion in this in the market is mostly from these 2 counters, particularly Vodacom. And to even alleviate the fears, it's the total combined drop of the 2 counters is about 680 billion shillings. Even though the total market cap dropped by about 400 billion, the 2 combined, the 2 counters, Vodacom and TCC, dropped by about 680 billion shillings. So given that the total drop of the market is less than the drop of these 2 counters, means other counters are rising. It means so the market, in a normalized market condition, the market would be appreciating. But the impact of the new trading rules and the improved price discovery, we see these counters now move from the prices that were stagnant to more accommodative prices. And that's why we see the dip of the market since the beginning of June.
And looking at the counters there, Imani, that you've mentioned, I do see other several major counters such as the JHL and even KCB seeing 0 trades. And I see, yes, these are cross-listed counters, but we also seeing CRDB and Afriprice leading in terms of the trade volumes there. So my question is, are we seeing liquidity concentration becoming an issue, or a structural issue rather, on the DSE? And how much of these are we seeing in terms of infrastructure and settlement limitations across listed shares as they continue to limit their tradability locally? What are we seeing here?
Yeah, the cross-listed counters has been an interesting encounter because we have 6 cross-listed counters in DSE, but we see very few transactions, or maybe non-existent transactions, for quite some time. And this has been, as you mentioned, a challenge from infrastructure, facilitation of infrastructure for trading of these counters. So you see cross-listed counters where, cross-listed from Nairobi to DSE, but then the transactions between these 2 markets, all of them, when you are non-resident, you would need a custodian account to be able to facilitate local transactions. Now, the cross-listing of Nairobi stocks to DSE would facilitate transactions in DSE, on the DSE market.
From Dar to Addis, Ethiopia's $2 billion Beer Startup Act, valued at approximately $36 million, was unanimously approved by the Council of Ministers on June 5, 2025, and now heads to the House of People's Representatives, with parliamentary approval expected by mid-July. So what does this mean for the country's tech and innovation ecosystem? We were joined by Bana Laurendu, founder of Nkopa Lab, for more.
Very exciting times, for entrepreneurs and the whole ecosystem in Ethiopia, because after a long 5 years, the Startup Act or Startup Proclamation has been approved by the cabinet, and we expect a swift also enactment at the House of Representatives. But I think, we need to kind of look at the bigger picture here. As we know, all around the world, entrepreneurs are the ones who create jobs and who create new markets, right? And I think the larger picture of this bill, right, is the fact that economic freedom and really the freedom of enterprise in Ethiopia is coming. It's already here, but now it's really coming through a piece of legislation. And really to illustrate that is the fact that the beauty of this bill is that a lot of people are taking credit for its enactment. meaning that there's really real ownership from all walks of life, whether it be policymakers, the startup ecosystem, the civil society. And really, I think almost 5 years ago, we had maybe some startups and ecosystem builders scattered around. But now we really have an ecosystem that's emerging. And that's really what we strategized 5 years ago when we started this at the Jobs Creation Commission under the Prime Minister's office, is really a mindset shift or mindset change management. And we did that with the Nkopa movement. And so to answer your question, right, I believe for investors now, it's not just the ability to establish in Ethiopia, which is very important because up till now, they had to go through a whole set of gymnastics to actually invest in startups in Ethiopia. But it's also the fact that they can really find a mature ecosystem that can really answer their needs.
Yes, Bernard, but does this act also maybe, will it crowd in or crowd out some of the early investors that we are already seeing coming into Ethiopia?
If you look at the US and even other advanced economies, the state usually also takes a certain amount of risk in terms of investing in very strategic and areas in the economy. For instance, in the US, if you look at space, the amount of grants and also just participation from the public sector is really there, right? So I think in Ethiopia also the fact that the public sector and in this case specifically through the Ethiopian Investment Holdings, which is the 34th largest sovereign wealth fund in the world, the fact that they're saying that we are ready to back up the startup fund in Ethiopia, and we're ready to act as a catalyst and a de-risking mechanism is something that is very good for the ecosystem. But they definitely, need to really help and catalyze rather than crowd out other investors.
And yes, Bernard, also looking more into this act, it has the revenue and employee threshold set in bear. So how might currency volatility and inflation impact a startup's eligibility under this act?
Yeah, so look, I think, the key for the success of this act, right, for the proclamation and then the directives that will come after it, is really the execution aspect. So definitely the directives are part of the execution, but then, there's going to be a committee that's going to be formed, just like other countries like Tunisia and so on and so forth, to say that, a startup or a company will get that startup label and will have access to some amount of incentives, whether it be access to a regulatory sandbox, access to that startup fund that we were talking about, and so on and so forth, right? So the way the committee will be formed is going to be really key, and the way they're going to really cook in a little bit of agility in terms of, that threshold that you were talking about, but also other aspects is going to be really, really important.
From market sentiment in Dar to policy shifts in Addis, East Africa continues to show signs of both resilience and reform. We will be tracking how these developments unfold in the coming weeks. Back to you again.
Thanks for the update there, Tabitha. Now, over here in West Africa, as the Iran-Israel conflict persists, analysts note that uncertainty would keep oil prices elevated. Meanwhile, the International Energy Agency says global oil demand will keep growing, peaking at 105 million barrels per day by 2029. Meanwhile, total crude production by OPEC members averaged 41 million barrels per day in May 2025. Pedro Omotueme, partner and oil and gas leader West Africa for PwC, discussed these developments. Take a listen.
Right now, we don't think that had not been factored into the prices that we see, because I'm not sure Israel has actually hit any export facility or production facility of Iran. So Iran is producing about 3 million barrels, exporting about 2 million barrels per day. So that production has not been hit. Once that is hit, I can tell you the price will change.
All right, but like you said, the implication for prices, we're looking at oil prices now, where we saw that quite jump there, but then we see more or less settled around $74, over around that price range. Is this going to be the new normal more in the near term?
I think for Nigeria, for example, if your budget is $75 per barrel and you are 74, Nigeria is happy. So anything that will help the country, that is good for us. Will it stay at 74, 75? Nobody knows exactly. Only the prophets can tell us where the numbers will go to. But this is affected by demand and supply. So once demand is more than supply, then the price will come down. If the supply were to go down, then obviously the price will ramp up.
Yeah, because we've had all those projections from Goldman Sachs talking about, the outlook for prices for the year and the rest of the year and all of that. But now we're looking at new dynamics playing out here in terms of demand and supply. Now, I'd like you to help us put that into perspective. Okay. So like I said, all of this is affected by demand and supply. Now, the OPEC Plus members, they're trying to curtail the supply because and in the U.S., the shale gas in the U.S., the shale oil in the U.S. have not been as much as expected. So I think if you look at the OPEC expectations, they're expecting a growth in the global demand. And then I think also, of course, nobody predicted the war, or not as quickly as it's happening. And that is going to affect the dynamics as quickly as anybody can project. So if the war continues, then the price will ramp up. If the war was to stop today and things go back to normal, then OPEC projections and OPEC expectations will play out.
Yeah, because when you look at the all pricing dynamics and you look at the entire lay of the land here, China is a very critical player in all of this. And we're seeing China move strategically to stockpile oil here. And I'd love to get your thinking behind that and what that could portend for the market.
So, of course, China is the biggest buyer of Iran's oil. So if Iran goes to war, China may not have that extra oil to get. So right now, that's why stockpiling. I think they may think that there's going to be a war here, so let's stockpile. Otherwise, they're going to run out of supplies or look for additional source of supply across the world.
But for countries like Nigeria now, how should we be navigating this terrain?
Okay, so Nigeria, our expectation is even with the new administration in NNPC and the government order is for them to increase production to 2.5 million barrels. Right now, if you look at the NUPROC's website, we are probably doing about 4.5, 4.6 as against our projection of 1.5. So Nigeria actually at the moment not meeting OPEC quota. And the ability of Nigeria to increase from 1.5 to the 2.5 or 2 million barrels is a lot of investment is required. The infrastructure is required, the investment is required, and we have not yet done that.
Let's talk about that investment drive now, especially in that space.
Yeah.
Quite a lot has been done in the CNG space. Yeah. We still expect quite a lot more to happen if we're going to get back to previous pre-COVID levels.
Yes.
And I love
2 million barrels. Yeah.
Yes, I love you to speak to the in terms of what's holding back investment and how can we more or less speed this up.
Okay. So for a long time, the international oil companies, the IOCs, did not invest in Nigeria. They were looking for other parts of the world where there was a better returns on investment. So what we have seen happen in the past 2 years, we've seen Seplat buy over ExxonMobil assets, and they're ramping up production. We've seen Shell sell off some of the assets to Renaissance, and Renaissance is going to ramp up production. So with the exit of the IOCs and introduction of what I call the local independent players, we expect that there will be increased production, and we're already seeing that. But that will take some time to get to the pre-COVID numbers.
In response to the recent downgrade by Fitch Ratings, the president of the Afreximbank, Benedict Orama, expressed confidence that the decision will eventually be reversed. In a chat with CNBC Africa at the 4th African Sovereign Investors Forum, Orama noted that concerns over the bank restructuring its loans are unfounded, citing the multilateral treaty that governs Afreximbank. Take a listen.
I guess we've been able to do what we've done in Afreximbank because Africans own and control Afreximbank. Yes. So we're able to do the kind of things that we would probably not have been able to do otherwise. So we have been able to have an African view to our problems and all the way to our board. So it's not just management. So we put Africa first. And that's because we are owned and controlled by Africans. And no place in Africa is off limits. We cannot state that our place is too risky. It's absurd for you to live in Nigeria and then you say that Nigeria is too risky. I mean, you live there. Yeah, it can be risky, but that is where it's like somebody saying the world is too risky. We live in the world. Where else will we go? We'll go to the Mars? You follow? Yes. So, as I'm concerned, where you make your money, you invest it in it. Okay, so if you want to diversify a bit, it cannot be that 70% of your money is outside your country. I would rather 70% is in where I got the money, where the money is needed, and maybe 20-30% is out. For that diversification you're talking about. But, I mean, it just doesn't make sense in my view. When you have made all the money and you are going abroad, and there has to be a different sense of going abroad, The sovereign wealth fund will come, if I'm a Nigerian and a businessman in Nigeria, and Nigerian sovereign wealth fund sees that I want to make an investment in Europe, and then they come and help me co-invest with me so that I made that investment is beneficial to Nigeria. That would be a good investment outside Nigeria, because that has a linkage to the country, because the owner is a Nigerian, the business is based in Nigeria, so that investment triggers benefits for Nigeria to trigger exports. It creates employment. There are so many things it can do. So because a foreign direct investment that is done. But the idea of saying, oh, take your money, give it to the fund manager somewhere so that they can preserve your money.
It's flawed.
It's completely flawed.
Yes, I'm talking about flawed perception now, Mr. President. Your response to the recent Fitch downgrade as well, that was one of the highlights of your statements here, and the need for Africa to have its own credit ratings agency. The expectation is that we should have one by September this year. Your take around the erroneous view from bodies like Fitch, and then your expectation from African Credit Rating Agency.
Well, I think we've made a release
yes.
with Fitch, and we've had engagements with them. And time will tell. They will see, after some months, they will see that what we told them is a fact. Yeah. And I believe they will reverse it. So it has happened to us before, by the way, and with Fitch also. Where they downgraded us on a particular issue, we had difference of opinion. And eventually they saw that we were right, and they reversed themselves. So we think that will happen with this, because if anybody, all the people who are making all these arguments, if they take their time, or they took their time to read the agreement established in Afreximbank, they will know that what is called risk doesn't exist, because that the Afreximbank will restructure, or the Afreximbank will restructure the loan. It doesn't exist. Because it's not about me. I can't even do it, even if I wanted to.
And that's all we can take on this episode. You can catch all these stories and more on our website on www.cnbcafrica.com. Thank you for joining us today. Until next time, stay informed and stay ahead with Africa Business Weekly. I'm Akin Obakeye, and we'll see you again, same time next week. Bye.